So this is our final one from chapter 3, and it's got more in it. It's kind of cumulative. It has all the pieces. So here they tell you about a purchase. At the beginning of 2009, Pullet bought Tudrey. And they don't tell you the purchase price. You have to figure it out. So they do tell you the book value, which is the 140. So what is the purchase price? They said that Pullet issued 12,000 shares with a par of 1 and a value of 200. That's the price they paid. They didn't pay it in cash. They paid it in shares. And so that is the cost, the fair value of those shares is what they paid for Tudrey. So the difference must be some fair value in excess of book value, and we have to assign that either to specifically identify differences between fair and book or to goodwill. So they say that the buildings were undervalued by $60,000, so we can write those up. We need to do that, the buildings here. And they also had equipment that was undervalued by $25,000. Okay, but we have to spread $100,000, and this is only $85,000. So the remaining must be goodwill. While we're here, we can go ahead and calculate the annual amortization. The equipment had a 5-year life, and the building had a 10-year life, so we can divide that out. So the annual amortization on the equipment will be the $5,000, and you can probably tell from just looking at it, it's going to be $6,000 for equipment for a total of $11,000. We'll need to use that $11,000 in our consolidating journal entries, so we wanted to go ahead and calculate that here. Now we're ready. I put this out here, by the way, for your notes, what the 5 classic consolidating entries are. So let's work on this. We see here the purchase was made on January 1st of 2009. So that would have been year 1. 2010 would be year 2. 2011 would be year 3. 2012 would be year 4. So we're doing the financial statements for year 4. Notice how in the prior activities they told you what year we were in. Now we had to figure it out. So each class activity builds on the prior and asks a little bit more of you. Okay, so let's do the consolidating entry. Let's start by eliminating the book value of the subsidiary. That's the S entry. We're going to do beginning retained earnings because this is not at acquisition, and so we're entitled to the full year's activity of the subsidiary in the consolidated unit. Well, nothing in that one, is there? Just a habit. And then the other side is investment in subsidiary. We'll add those two together, or 3, even though one of them is 0. So now we're going to use the amounts that we calculated originally, and we're going to set up the assets after year 1, 2, and 3 has amortized 3 years worth of this amortization that we calculated down here. So let's start with the equipment. Originally it was $25,000. We would have charged $5,000 in year 1, $5,000 in year 2, $5,000 in year 3. We're going to do another $5,000 in year 4, but we're going to do that in the current year. We're not going to set that up as a beginning of the year amount. So we're going to do $25,000 minus $5,000 times 3, or $10,000. Let's do the same thing for the building. Originally it was $60,000. We would have charged off $6,000 in year 1, $6,000 in year 2, $6,000 in year 3. So that would be $18,000 that's been charged off. So $60,000 minus 18 goes up here. this is the A entry. And of course we've got to put in the goodwill, which we calculated down here. And then the other side of that is the investment account. Okay, let's eliminate their share of income. Remove it from the investment in. Let's remove the dividends. If you do this enough, you start figuring out and remembering these various journal entries. The letters are not required, they're just convenient. Your author thinks they're helpful to remember the things, the tasks that you need to do. But I don't require it if for some reason you find that an additional thing to learn and that's a problem for you. So now let's take the amortization for the year for building and for equipment. And then we'll put that in with expenses. Add them together. And so there's that. All right, let's check for debits and credits. Should have done that at the beginning. I keep forgetting to do that. Okay, our entries balance, that's great. So now we've got to do the math. This is cross-cast, a horizontal summation, until we get down to net income, and then it's vertical. Okay. And net income comes from above, not from across. And retained earnings is vertical. All right, so let's see. Investment account we have to do individually because it is a multi-line account here, as we mentioned before. So plus this minus these three will hopefully be 0. Okay, good. And then retained earnings comes from above. And now let's see, these are vertical summations, the total assets and total liabilities and equity. Let's see if our balance sheet balances, and if not, we start troubleshooting. Okay, it works. Very good. It's time to move on.